reports that you're likely to see as you work in your business to kind of understand how your business is doing, the health of the business, and then looking at what might show up as issues that you want to investigate. Because those reports, primarily the income statement, the balance sheet, and the cash flow statement, are really going to be kind of your thermometers, right, for telling how your business is doing. They're an opportunity to really kind of look at that at least once a month, so that you're not letting problems that may occur get worse. You're holding people that are doing work accountable for doing the right job. So tonight's presentation and workshop is going to be, we're going to start off talking a little bit about a review from last week, and then we'll start looking at an income statement to kind of help frame the rest of the evening, which we'll be talking about where common problems are in businesses. And these are problems that will show up in your balance sheet primarily, but giving you an idea of what to do in the event you come across them. We've got a couple of handouts that were sent earlier today. If you've got a chance to look at those, great. They will be hopefully very useful to you after this workshop. So you kind of use them to figure out things like pricing or the margins and those kinds of things. So, let's see. Yes. Part of what we're going to talk about today and what we talked about last week was this notion of building new habits and finding yourself as you're running your business, working in your business, using new approaches, new behaviors, new habits to make yourself more effective as the owner or the entrepreneur that you want to be. So a lot of what we're going to talk about is doing these reviews regularly. And it's important that you think about that in your day-to-day activities and in your efforts, because regular reviews are really important. With that being said, why don't we kind of pick this up with a quick bit of review from what we covered last week. Here we go. So you'll remember last week we talked about the fact that managing financial reports is really a helpful and effective way to allow you to reduce firefighting and stay productive in your business. My own personal experience is that the more financial reviews I did and the better I understood my financial reporting, the better I could run my business day to day. It may not seem intuitive, but that's really the way it worked out. And that little graphic of that guy with all these spinning plates, that's really what I'm talking about. Is, our job as entrepreneurs or our job as business owners are to keep all those plates spinning. And what you'll find is you do that a lot more effectively when you understand the financial parts of your business. So you're not having to stop and fix something all the time. It becomes a habit of review so that you can anticipate and fix things before they get too bad. The second part of this is what we call the planning pyramid. This was an idea of how businesses oftentimes are organized, starting with core values and getting all the way up to who's doing what. But reviewing financial reports is an important part of that planning pyramid. And when we talk about what that planning review is, we talk about it in terms of PRE, or P-R-E, planning, evaluation, and reflection. So we spoke quite a bit about that last week. And that's something you'll hear again as a theme. Another thing we talked about last week, and this is kind of a busy slide, but I think it offers some good insights, and that is, our business as business owners and leaders and managers really kind of has two parts to it. The part on the left is all about working with people and relationships. It's about developing, growing, keeping a good reputation. It's about working with employees, customers, shareholders, ensuring that people are aligned, and ensuring that people are following a common vision. Vision sometimes these days gets a bad rap for being kind of fluffy and maybe not so important. I personally don't believe that's the case. I think if a company or a leader doesn't have a strong vision about what they want to do, oftentimes they get distracted. Oftentimes they find themselves doing stuff they never intended to do. Oftentimes their businesses kind of go off the rails because they've made choices and decisions that aren't particularly good for the long-term view of the business. So that's what that left side is all about. Doing the right things. What should I be doing as the business owner or leader? On the right-hand side, this is about productivity. This is about the day-to-day stuff of running your business. And this is where you're going to spend 99% of your time is, figuring out how to improve productivity, how to make it better, faster, cheaper, how to keep money from being lost, how to be profitable, how to keep, inventory and your accounts receivables all in control. So that's really what the right-hand side of the screen is talking about. That requires alignment. And when I talk about alignment, it sounds perhaps like, if I'm a sole proprietor, what am I aligning? Well, probably not much. But when I've got a dozen people working in my company, when I've got partners that I'm working with, when I've got shareholders that I've got to work with, it's getting those entities, those people aligned. And that's a big part of what this graphic really addresses, is the need for that alignment, making sure that we have a common understanding of our core values, our purpose, our targets, goals, and so on. Questions about that? It's kind of a busy graphic, but it's interesting if you spend a little bit of time kind of looking at it, it starts to make sense. And it took me a while to kind of appreciate what it was telling me, but I think it's a helpful perspective to have. We also talked about a couple of other things, concepts with respect to running your business. We talked about the fact that when you add people to your organization, it becomes much more complex. So when it's just you or you and a partner, there's one-to-one communication. So each person has to communicate with the other. But when you start to add people, even a third person or a fourth person, you can see that communication really becomes quite complex. And not to mention what happens when you start to get 15 or 20 or 30 or 100 people in your organization. Making sure that people are aligned and informed are a big part of your task as a business owner or as a leader. The other concept that we talked about was this notion of a client matrix. And where we discussed this was there's a combination of solutions and clients that you can consider when you're looking at how to sell and market to people. And what we talked about was the fact that selling to existing clients with existing products or services is by far the easiest thing to do. And oftentimes in this context, easy translates to profitable. The next best is selling new solutions to existing clients. And that's almost as good, right? You're dealing with people where you have a relationship, trust has been built, and you're allowing your client to sort of have access to new solutions and new products. And that's usually where growth occurs. The third one in the bottom right-hand corner there is selling existing solutions to new clients. Oftentimes that's pretty costly from a cost of sales point of view. You've got a lot more sale investment that has to take place. While you still have the same solutions that you're providing, oftentimes clients want them in a different configuration or they want them done differently. And so that adds complexity and cost to your business. And last but not least is that idea of new clients and new solutions. And that is really where new companies find themselves, right? When you're just starting up and you're a startup, you're going to find yourself in that place where it's really tough because it's costly. You're drinking from the fire hose when it comes to learning stuff. You're having to reset and rework things, and that's when it becomes really difficult. So that notion of client matrix is helpful here. It's something that we'll touch on as we go forward over the slides that come on. So before we jump into this, any questions so far? And y'all will get a copy of the presentation, so if don't sweat it too much. So when we talked last week, one of the primary reports that we looked at was the income statement or profit and loss statement. They are the same thing. And because we're going to go into a little bit of detail here, what I thought I would do is break it in half. So what we're going to look at, first of all, is the top half that includes where our sales are and where our cost of goods sold are. So these are two parts of the same report. One is where revenue is coming from, which is sales, and the other is where cost is coming from to match up with that revenue. So here we can see you've got the sales part, you've got the cost of goods sold piece that we'll talk about in a little bit of detail. And then also in this report, something that we talked about last week was the fact that when you're reviewing reports, it's really helpful to have a historical reference to consider. So I would encourage you, when you're looking at reporting, don't just look at current month. Look at current month or current year compared to what you did the same period last year. Without that, you really don't have a good point of reference of whether business is picking up or it's going down. And you might find that it's doing both in different parts of the business. So it's really helpful to have that reference point of what was I doing this time last year? Or what was I doing last month if you're doing a month-to-month comparison. The other thing that's in here that you want to look at is revenue mix. So when we're talking about percent of revenue, it's a pretty easy calculation. It's looking at that particular line item. So let's take the top one. In-store sales, we can see that that's $29,843. And if you go down to the bottom of the sales area, you can see total sales are $128,288, right? So that first line item of $29,843 is 23.3% of your total sales for the period. Does that make sense? Kind of see how that works? So that gives you an idea of, am I talking about a big deal or am I talking about a little deal? Am I talking about my in-store sales of 29,000? That's a pretty big deal. But my delivery sales of $6,995, that's probably not as, in the scheme of things, it's a much smaller percentage of sales or percentage of revenue. You probably don't have to worry about that as much. So this gives you kind of an easy way to prioritize, where do I want to look? You can also, when you compare it to what took place last year, you can see where the differences are, right? Last year, in-store sales were 26.7% of total, and this year they're 23.3%. So that percentage has gone down. That's shifted. And then if you look to the far right, you can see the change column. So you've got a dollar change. So that changed $10,822, that first line item. And the percent of change, it changed almost 57%. So that's not insignificant. But the dollar value is relatively low, so it may not be something that you break a sweat over. But it gives you context. It gives you an idea of what you're working with. I'll stop here. Any questions or thoughts about that? Okay. So at the top, we have sales. And those sales are broken down by what we call lines of business. So this is a fictional flower shop, and Sarah, the owner of this flower shop, has basically taken each of her lines of business, so in-store, delivery, recurring floral services, wedding floral services, trade shows, and she's broken them out, and in her reporting has separated them so she can see how they function apart from one another, and then how they function together under the total sales figure. So again, this provides you some granularity in understanding how the business is shifting. Where is it going? How is it working? What's growing? What's increasing? What's decreasing? So it's a helpful way to look at the business. If we take a step down, we can see the cost of goods section. So these are costs that are directly related to selling the product in the sales category. So that's the way these income statements are organized. You've got sales or revenue at the top, and then right below that, you've got the cost of goods sold section. And this again is split out by line item, so you can kind of get a sense of where your costs are coming from to produce that $128,000 in sales. So if we look at this report, we can see that we've got cost of sales from in-store, we've got delivery costs associated with the delivery of the product or the services. We've got costs associated with reoccurring floral services. And because we've got this as a percent of revenue, as well as a percent of, or as well as compared to prior year, now you've got an opportunity to start seeing where things are shifting. Right? We saw that on the sales side. Now we can start to see that on the cost side. At the very bottom, we can see gross profit. So gross profit here is represented in both a percentage of revenue and in dollars. So you can see for the current year, we made a gross profit, or Sarah did, of $66,115, which was 51.5% of revenue, which is a pretty good return, frankly. And then you can also see how that compared to last year. Last year, you could see here that she had 49.3% of revenue was her gross profit. That represents about a 2.2 pennies per dollar earned. So for every dollar that you have in gross profit, you're getting about 2.2 cents more this year than you got last year. That doesn't sound like much. But if you're doing hundreds of thousands of dollars, that adds up pretty quickly. So that's a nice number to see. and a nice way to look at it. And a good way to explain it to people when they're asking about, what is our gross profit, those kinds of things. It gives people an insight into what's happening. If you're talking to people about cost reductions and possible layoffs, this is a great place to go to show them how the business is doing. Because this is a pretty loud voice with regards to the health of your business. The next thing we want to talk about is gross profit versus markup. Now, this is something that kind of had me sideways for a while because I kind of thought they were the same thing, but they're not, right? So in this example, you see sales of $167. You see cost of goods sold at $100, which says you've got a gross profit or a gross margin of $67. The calculation for that is 67, which is your gross profit, divided by 167, which is your cost, which is your sales, gives you a 40% gross profit or gross margin. Makes sense. Interesting, however, that is not a 40% markup. It doesn't work that way. And we'll see that in another slide here. So to get markup, you want to take your cost, which would be $100, right? Less your gross profit, which is 40%. Let me get this right. You start with your cost of goods sold, and you apply your gross profit, which is that 40% to that. So you remove that 40%. That equals a formula of $100, which is your cost, divided by 60%, which is your costs. It's costs of 60% of that 167, which gives you a $167 figure. Let me kind of show this to you in one of the handouts, which I think will show you a little better. So let's say we've got a sale price of a product. Now this is kind of getting into product sales. But you've got a sales price of a product, and we'll say that is $200. Okay, so that's our sales price. Then let's look at, we'll just add one cost here, but these yellow fields are where you would put in costs associated with providing that product that you're talking about. So this might be something that you sell or a service that you offer. But here in these yellow cells, you can add costs, right? So you can add salaries, you can add product or operating costs, you can add variable costs if you've got them, and this will give you a figure that will identify what your pricing is. So we're going to start here and say we've got costs of $75. Okay, so that says that $75 is 37.5% of sales, right? And then if we come down here and look here, we can say that the gross profit using the sale price for $125, which is the difference, right? This is the profit between the difference between 75 and 200 gets you that 125, and that gives you a 62.5% gross profit. Does that make sense? So using this spreadsheet allows you to kind of take what your pricing is, and I know, Jeremy, you and I talked about pricing at one point, right? Taking pricing and now putting in the different aspects of cost to provide that pricing, and it gives you what your gross profit is, as well as tells you what your costs are. You can also put in a desired profit. So let's say we've got a $200 sale, and I want a desired profit of $50. So if you come down here, let's see. Calculator. Sorry about that. Well, what should happen here is that 50%, oh, I know what it is. It's because I've set a desired profit less than what I'm already getting. So let's say I wanted a 75% profit. I didn't do it either. Well, the intention here is that this will show you what your sales price needs to be in order to have your desired profit. So my apologies if this doesn't seem to be what it is. I think so, but let's try it. Looks like it's this. Well, I think in the version that you have, you should find it working better. So let's go back to this, the PowerPoint presentation, and we'll pick it up. Okay.
Hey, Mike, I have a question. So,
yeah,
would you recommend using this tool to come up with a unit price, for example? Because sometimes for business owners, it's really hard to price the products.
sure,
So I think this can be a great strategy, right? Come up with a unit price.
it can.
Yeah.
What this doesn't show you, though, is it doesn't show you what competitor pricing is and what the market will bear. So it just gives you a sense of how profitable. If I price it at $200, what's the profit? Versus if I price it at $175, what's the profit? So now we're going to look at the lower portion of the income statement, which is where we start to see operating expenses, net operating income, and other expenses. And there's a concept in here that I want to talk about that's called leverage. And you really don't get the sense of leverage until you start to compare current year to prior year, or current period to prior period. And so that's something that we'll talk about here as we go through this. In your QuickBooks, I think you should be able to double click on these figures and see where the numbers are coming from. What's creating those figures? So that's something that's important to know. If you're not using an automated system, there's a lot of efficiency that's created by using something like QuickBooks or another product. What we want to be able to do, much like we did in the other report where we looked at sales and cost of goods sold, we want to be able to look at percent of revenue, and we want to be able to look at prior years. So that's an important part of what we want to take a look at. Here, where you see these two total operating expense numbers circled, these are representations of current year percent of revenue. So you can see the current year operating expense in dollars was $56,183. in prior year was 24,222. So currently, this operating expense number is 48.8% of revenue. When we look at last year, it was 34% of revenue. This 24,222 was only 34%. So we're looking at the same category of costs. We're looking at a different sales number, of course, but as a percentage of revenue, this is a higher percentage of revenue than this is. So that means that we're in these sales or these cost categories, we're not getting leverage, right? We're not as efficient. Does that make sense? Kind of. Okay. So you can see that we've got all of the costs associated. So we've got labor costs and they're broken down. And then we've got fixed expenses and they're broken down. And we've got them for both periods. So when we get to the sort of total operating expense for current year, we can see that those expenses added up to 56,183. And for the year's sales, that was 43.8%.
Okay, all right. Percentage of revenue.
A percentage of revenue or sales, yes. Yeah. So that's the percentage of current year sales or revenue that we looked at. Last year, those same costs were only 24,222. Now we don't, we could go back, I guess, and look at what the sales were, but this number of 24,222 was 34% of sales last year. So effectively, what's happened is it's cost us more as a percentage of revenue for this year's operating expense than it cost us last year. So it's worth taking a look at that. What's happening? Well, if we look, we can see that a majority of that expense actually took place, right? There's a total of $31,961 of difference between the 2 years. And we can see that $28,192 came from labor-related expenses. So what's the difference? Part of the difference is that Sarah, right, gave herself, owner salary, gave herself a salary bump, right? Her salary went up by $3,333. She also gave raises to her employees because they went up $7,000, almost $8,000. She also added a profit sharing plan, which added $12,700 in expense the current year that she didn't have last year. So you can now start to see where the differences are showing up. What the heck is happening? Why am I not as efficient this year as I was last year? Well, in Sarah's case, the reason is because she's giving people raises. She's putting money back into the business. She's started a profit sharing plan. And it's showing up, it's having an influence on her operating expenses, as you would expect, right? It makes sense. So here are a couple of examples of where leverage helps. We just talked about that. Where there's an example of getting leverage, of seeing more efficiency apply. One of them is in location expenses. So this is talking really about, obviously she's got a flower store. She's probably talking about a brick and mortar retail store, right? So the cost for brick and mortar this year was 3.4% of revenue. The cost last year was 5.9, almost 6% of revenue. So the cost was a higher percentage last year. And so she's using that resource, that expense, more efficiently this year. That's good. She probably hasn't done much other than consolidate businesses. Maybe she's closed an office. Maybe she's not paying for a home office that she's paying an employee, something like that. But her costs have gone down. Additionally, administrative costs, right? You can see that last year they were 0.8%, and this year they're 0.5%. So even though the dollar value is larger, as a percent of revenue or as a percent of sales, it's a smaller percent. So she's using, as a percentage of revenue, she's using her resources more effectively. Now you'd be really tempted, and I've been really tempted to say, well, wait a minute, you know, she spent $645 a current year, and last year she only paid or spent 605, right? So we're comparing these two numbers, 645 versus 605. Right? So it's not a big change, but the fact of the matter is, we just talked about 2.2 cents improvement, the bottom line, right? When we were looking at gross margins, that's what helps make that up. So it's not oftentimes big dollar numbers that make you feel good, I want to buy a steak dinner. They're little tiny improvements that you see in these line items. So that's really, as a business owner, that's where you're trying to find efficiency. That's where you're trying to leverage your assets so that they help you do a better job of using the money that you've got. So we talked a little bit about business metrics last week. And I want to start the conversation around, you know, what those different business metrics might be. We looked at the income statement here, and certainly an income statement is a good key business metric that we want to cover. But we're going to talk about other business metrics that would be important. So some of the things that you want to keep in mind as you think about what business metrics are you going to measure in your business, right? They need to be easily obtainable. If you've got a bookkeeper, you want your bookkeeper to know what business metrics you're looking for, so they can ensure that the reports are available for you to look at that give you a view into those metrics. You want to make sure that they're simple to measure, so they can't be really complex. I've gotten twisted around an axle when I've tried to make my business metrics and my business reporting too complex. It becomes difficult for people to continue it. I keep forgetting what I meant, so it becomes difficult. It has to be simple. It needs to help you and your team stay focused. These metrics, you know, remember we talked a little bit about alignment in an earlier slide. These metrics help you stay aligned. These metrics help you say we're doing great or we're not. And you as a leadership team or as a business owner, you've got to have your business owners on the same page about what the business is doing. So everybody has to sort of look at it the same way, and metrics help you do that. You have to provide quantifiable, fundamental information to make better decisions. And that's really the whole point here. You don't want to find yourself a couple of years into your business and find out you've not been paying sales tax. And the day you find out is because the city of Thornton has showed up to do a sales tax audit. And you're a little worried because you've gone through 3 bookkeepers and nobody has told you anything about sales tax. You got no idea what it's all about. And the person that's doing the audit looks pissed off. So that's the bad time to do it. So these help you make good, better decisions by managing your business metrics. You want to make sure you've got a process that's helpful in identifying what those metrics are. Start simple. Start with the 3, an income statement, a balance sheet, and a cash flow statement. And then start looking at other metrics, sales metrics, for example. Repeat sales to clients, sales of particular product lines. We saw how Sarah had broken out her sales by line of business. Maybe that's one that you want to look at. But they need to be meaningful. set goals for the team. And this might be both team goals as well as individual goals for managing the metrics. I worked for a company that did this really, really well. So what they would do is every quarter, they would identify team goals for the following quarter. And then individuals would take responsibility for individual goals that help make the team goals. So you might have a team goal for selling more flowers, right? And then you'd have your sales director, or maybe it's a salesperson who's doing the flower sales, has an individual goal to make the team goal happen. So it's kind of a stair step, and it works really, really well, particularly if you hold people accountable and you go back the following quarter to see how you've done, or you check during the course of the quarter to see how they're doing, and you give them feedback. You know, you're a bit behind the curve here, or you're killing it, whatever the case may be. It's a great way to help keep people motivated and aware of how the business is run. You want to develop action plans to achieve the goals. You want to monitor your metrics to make sure that you're moving in the right direction. And as I mentioned earlier, do this as a team. Leadership teams, ownership teams that meet on a regular basis and look at business metrics for the business, outperform their competitors head and shoulders. I can tell you that by experience. If the leadership team is all on the same page, they're aligned, they know what they're going after, they know what their goals are for the current quarter or current year, and they're working towards them in concert, they will kill their competition, because most people don't take the time to do this. Last but not least, you've got to learn, so that's missing an R. You need to learn from your shortcomings and your failures. You're not going to hit all your goals. You're not going to hit all your metrics. You're going to have mistakes. But if you learn from them, if you do, you call it a post-mortem, you can call it whatever you want to, but go back and look where you failed or where you had shortcomings, you will learn from them. Particularly if you've got metrics that you're confident in, that they represent, parts of the business. You'll learn, and your business will improve. And then last but not least, celebrate success. People like to hear that they've done well. People like to be recognized. Teams like to celebrate together when they do something right. So celebrate. Don't let it go by and think, well, I'll get it next year, or I'll get it next year. Take time to congratulate people for doing a good job. It really helps. So here are some examples of key business metrics that you might want to consider. Number of leads generated, lead conversion rate, percent of revenue growth, sales increase by geographical region, sales by employee, so on. And then here's some marketing metrics, growth rates, retention rates of customers. That's a big one. We talked about that client matrix. Keeping clients is so important because it makes your job of selling and running your business so much easier. So if you're losing clients, that's a big red flag that you need to work through. Figure out what's happening. Look at maybe transactions per customer. How many times are you selling products to the same customer? We used to manage what we call client lifetime value. And client lifetime value came about because in the business I was in, you recognize that 80% of your revenues or sales came from 20% of your clients. It was the old Pareto metric. And so what you want to do there is look at how often am I working with a specific customer, and how profitable is that? It's really, really insightful to be able to say, you know, my top 5 customers represent 80% of my business. You don't have to guess real hard who you're going to focus on to take care of. The other thing that's interesting about this, and something that you might want to consider, is that to collect these metrics can be difficult. But there are a lot of products that are either services or products that you can buy, CRM products, client requirements management kinds of products that are available that you can rent effectively, that are online. And a couple of them might be Monday Sales, HubSpot, Salesforce, and one that I particularly enjoy using is a company called Pipedrive. Pipedrive, one word. And effectively what they do is they give you a database and you fill it in, and it keeps track of all your sales orders, it keeps track of all your clients, it keeps track of your leads, it keeps track of you know, how much revenue you've got. It helps you in your quoting process if you make quotes. It does a lot of great stuff. Now, all of these other products do that as well, but I thought Pipedrive was one that really worked well.
Software is also good. Software.
Ah, okay, right. So good. A lot of times entrepreneurs think of themselves as the best salesperson for their business. And a lot of times that's true. But if you're selling all day, right, you don't have time. You find that you become interrupt driven when you have to do things like this, right? Reading reports, evaluating your business, considering metrics. So it makes it difficult as an owner to do a good job at sales as well as do a good job with managing your business. So I would just encourage you, you know, look at a CRM system. You know, you can get them for probably somewhere around $30 a month to start with. They scale pretty quickly, but you know, small outfits are pretty small and pretty affordable. And then also look at, you know, how can I leverage people in my organization to help me sell?
So would you recommend one of those CRMs versus the other ones, like depending on the type of business?
I don't have a recommendation for the type of business necessarily, Andy. I think you just have to kind of look at them. There are a couple of websites that will allow you to compare them one to another, and then look at their features to see, you know, maybe I don't do proposals, for example. So maybe I don't need proposals in the service that they offer. So that's what I would recommend doing. It's just looking at it. Okay, so we're going to start now with looking at various topics. And this is going to get kind of tough. It's not easy to talk about problems without seeing evidence of them. So you're just going to have to listen and kind of get it textually, not necessarily looking at it on paper. But I think you should be able to kind of come away from this conversation with some sense of where to look for problems if these things happen. This whole conversation as we go forward for the next many slides is about a statement: cash is king. So we talked about last week the notion that I can be profitable every month and run out of cash and have to close my business. So profitability is great. It makes you feel good. But if you don't have cash to run your business, you're pretty much out of business. And the harsh reality is that banks and investors aren't going to loan you cash to keep your business going for very long. And if your business is not well run and you can't explain your business model and your business metrics, then people get really reluctant to give you anything. So what we're going to be talking about here is going to be important. Cash is king. So the first thing we're going to talk about, we mentioned a little bit last week, this difference between variable versus fixed costs. So variable costs go up or down based upon your sales. So if your sales go up, variable costs go up. Variable costs typically are things like inventory or direct labor hours, the hours that takes to make a product or provide a service. So salary tends to be a variable cost for production people, and it tends to be a fixed cost for managers. Right? And there's a difference between a salaried individual, non-exempt salary individual, like you probably are, Jeremy, where you get a salary and you could work 40 hours or you could work 80 hours. And the salary doesn't really adjust all that much, right? So we're not necessarily talking about salaried individuals here. We're talking because you don't get overtime. We're talking about hourly or production people. So these are your crews that are going to go out and provide the services. They're going to be production people on the factory floor. They're going to be telemarketers if you're in that business. These are people that you pay hourly. And one of the things that happens is, and it's kind of an insidious problem, is that as the business picks up momentum, you want hourly people to work more hours, right? You want people to do more. So you're paying people a salary, you're paying people a wage, maybe it's $10 an hour for 40-hour week, that's $400, right? And you go to that person and you say, I want you to work another 10 hours, right? And I'll pay you overtime. Well, that's a good deal. They get a benefit and you get extra production or whatever it is. And so that works really well. Well, the problem is that if you set the expectation that overtime is going to always happen, will always be there, people stop asking for permission to work overtime, and they just submit a time card with overtime hours on it. And it's not that they're cheating you or that they're bad people. It's just that you've gone to them week after week, asking them for more overtime, and they kind of assume that this week you wanted me to do that too. So I've got things to keep me busy, and so I put hours on my time card for overtime. If you don't watch your salaries, that overtime number will get big and it will become a problem. Another area where cash gets sucked up quickly is in advertising. Lots of different ways in the modern world. We get pay-per-clicks, we can do flyers, we can do those kinds of things. Pay-per-click is typically considered a variable expense because you can set, I pay for every click that happens. So if I don't get clicks, I don't pay for it. Whereas flyers are more of a fixed expense, right? I print 50 flyers and I pass them out or put them on windshields, whatever. So that's the difference between a variable expense versus a fixed expense. And if you're not monitoring the effectiveness of your advertising, you're probably going to be, at some point, you're probably going to pass the curve where advertising becomes less and less effective, but you're still paying for it. So advertising is a big piece here that you need to look at. Sales commissions is another one. Are you paying a salesperson a salary? Are you paying them just commission? Or are you paying them a combination of the two? So that's an important thing to understand. How are you doing that? It's not unusual for startup businesses to pay 100% commission for their salespeople as they get started. And then once they become, excuse me, I take that back, I said that incorrectly. It's not unusual for startup business to pay a salary, and then as they become more and more profitable, start to wane that salary back, start to add commission to it. So that you've got a combination of salary plus commission. So that's something else that you want to look at. If you've got a really good guy that's selling a lot for you, putting him on more of a commission probably helps him out. He probably makes more money. One of the things that happened to me in a business was I started people off with a 50-50 compensation package. 50% was salary, 50% was commission. And as they became, more effective in their jobs, I brought the salary down and I brought the commission up. The problem is that I capped the commission at a certain amount. Salespeople don't like it when you cap those kinds of things. And so once he got 100% of his commission, he knew he wasn't going to get any more paid for his effort. He stopped working. And I kept calling him, asking him, how come you're not out there selling? I said, well, what? It's November. I've made my number. You paid me everything you're going to pay me in commissions based upon the plan you gave me. So I can take the next 6 weeks off. And I can start a new program in January. And I realized that was a mistake. So oftentimes your commission plan has to allow for, maybe it's not the same percentage of sales after they reach 100%, but they need to be able to earn more salary. Another place where this happens is bonuses versus 401k or employer contributions to 401ks. This is an interesting problem. A lot of times, companies will have a bonus program and employees will get paid even though the company isn't making money. That is a losing proposition. You can't do that. Your bonus program or your 401k employer contributions have to be set up so that the company doesn't pay if it's not profitable. And it's profitable.
How would you explain that to your employees? Like, so you're actually thinking about being enrolled on a 401k program. What would be an example of something where it would say, once we turn unprofitable, then that would go away, or?
Yeah, so the way it's oftentimes been explained to me is the company can't pay you a bonus or pay you in profit sharing, which is effectively what a 401k is. They can't pay that if they're not making money. If I have a loss for the year, I can't pay that because I don't have funds to put into a bonus program, or I don't have funds to put into a 401k. So if the money's not available, I can't pay what I don't have.
Is that typical? I guess I've never heard of it like stopping and starting based on profitability. Of course, a lot of companies are profitable that are doing that, but yes, to stop or I've not never.
So it's not so much that you don't stop it, right? The plan is still in place, but the company doesn't make a contribution to it for that period. And what my encouragement is you want to measure it quarterly. If I'm profitable quarter one, I pay a quarter's worth of profit sharing or 401k contribution. Quarter two, maybe I'm not profitable in second quarter. So I don't can the program, I just don't pay it. And that's a tough message to deliver as an owner, to say, guess what? There's no contribution to your 401k this month or this quarter. But the key is, and the message should be, right, there's a fundamental message here. We're all in this together, employers, employees, owners, staff, we're all in this together. So if the company makes money, we get the bonus, we get the 401k contribution. And if the company doesn't make money, then we don't either. That's not to say you don't get your salary, you still get your salary, we're still paying you the salary. But the upside, the profit sharing doesn't happen if we're not profitable. And I mean, it's a humbling experience to stand in front of, in my case, it was a couple of hundred employees and say, the company has been paying your 401k consistently for the last 8 quarters. And quarter number 9, we can't pay it because we weren't profitable. And so what you get is you get employees that will come back to you and say, well, what happened? Why aren't we profitable? And that's when you have to be able to start having a conversation about what's happening in the income statement, what's happening with sales, what's happening with costs. So they're aligned. So they get what's happening. And a lot of times they don't agree with you. A lot of times they're pissed off, but it's better to be transparent than it is for people to guess what's happening. That's my sense. A couple of other things to think about from a cash perspective. If your business is seasonal, a lot of times that requires cash flow planning, right? So when things are rich, put money aside for those months when it's not. That whole idea of conservation. You may need to build up inventory for the next holiday season or the next summer when you're doing, maybe your business is seasonal that way. I know my wife is a clay artist, and the Christmas season is a big time for her. So she builds inventory up all year long, which means she's taking raw materials and all this kind of stuff. So we see lots of costs at the beginning of the year, but we also see the benefit, the sales of it at the end of the year for the holiday season. It may require setting up a line of credit so that you can keep cash flow going if you've got seasonality in your business. A lot of times banks will do that if they understand that your business is seasonal, and you show the track record, excuse me, of being able to manage cash. You may have seasonal workforce, right? Maybe you add people to your payroll during certain parts of the year. And kind of going back to your question about the bonus and the 401k, something that just crossed my mind, those should be in writing. And you should make sure that before people sign to participate in it, they understand what the terms of the plan are. And getting an attorney or a human resources professional would be the right thing to do for that. Another kind of influence to cash oftentimes is the difference between purchasing or leasing equipment. One of the things that I think COVID taught us was that when businesses go out of business, they sell off their capital equipment, they sell off their office furniture, they sell off things, and that there's a market out there for that. So look at buying used or look for deals, look for equipment, furniture, fixtures, those kinds of things on the open market as opposed to buying new, or as opposed to purchasing something that you have to finance. Maybe you can buy it outright, by buying used. Another thing that it's important to note here is that when you're buying equipment, oftentimes that is a capital asset purchase. So large equipment, maybe it's machinery, maybe it's, you've outfitted an office space with new cubicles, maybe it's new production tables, whatever. Those have a lifespan to them. And so they don't get applied to your income statement. They're not an expense to apply to an income statement. They are a balance sheet item. They become an asset on your balance sheet. And they depreciate over time. So you're not taking this huge hit for buying this equipment in 1 month. You're actually putting it on your books as an asset and then depreciating it over time or amortizing it over time. Does that make sense? Kind of get that concept? It's important to have a good understanding of what that dollar threshold is. And usually, if my fixtures or furniture have a less than a year's lifespan, then it's applied as an expense. That goes to the P&L or the income statement. If it's longer than a year, then usually that becomes an asset on the balance sheet. One of the things that we talked a little bit about last week, and we'll talk a little bit about a little later on, is this notion of you might have to sacrifice a little bit of profitability for cash. Remember last week we talked about how it was much more efficient to buy monthly increments of inventory and use them monthly than it was to buy 3 months of inventory and then work it off over the course of a quarter. Well, the same thing sort of applies here. It may mean that you have to pay a larger or a higher increment or price for the inventory, but it doesn't suck up all your cash. So that's oftentimes something you have to do. Not buying bigger quantities to get a lower unit price is oftentimes something you're cause. That's not to say that you can't go back to your vendors and ask them for annual volume discount pricing. So maybe I don't get the discount every time I order it every month, but at the end of the month, if I've fulfilled my obligation to buy a quantity from you, then you write me a check for whatever the difference is between the price I paid and your volume discount pricing. So oftentimes that's a good way to approach that. When you know you're going to take a lot of material or product from somebody, but you can't afford to pay up front for it all at one time, buying it over a monthly increment, as long as you take it all, then maybe they'll give you that discount. Does that make sense? Yeah, annual volume movements. Ownership, employee ownership incentives. Ways that you can sort of keep your employees engaged or keep them on payroll. That's a big piece of where a lot of times companies will give an employee ownership. Right? I'm going to give you stock. I can't pay you what you're worth. On the open market, you're going to get a much higher salary by going to work somewhere else. But I'm going to give you stock, which will have a value to you over time. And that's a strategy that works and makes sense. But you need to make sure that your agreement with that employee is such that if they leave the company, they don't retain their ownership. Now, let me tell you a story. I took over a company in North Carolina, and it was failing. We turned it around. We got it profitable. We brought in some new board members. It was going really well, and we ran it for about 10 years. And I had an offer from a competitor to buy it, and the offer was a pretty good one. I mean, the owners of the company all saw benefit right, to sell them. So we start going through the due diligence of, all of the things that a buyer is going to ask about. So who owns your stock, right? And we come across this obscure agreement that this guy that worked for the company 10 years ago or 15 years ago was given stock. And the agreement was that he kept that stock after he left. He didn't do anything else for the company. He didn't provide any benefit to the company after he left. But here he was owning about 2% of the total shares of stock for the company. It was, I was flabbergasted. So I thought, well, surely he is going to feel good about the sale because he'll get his 2% back, right? He'll earn on that 2% of ownership. And I call him up. Hey, Richard, what do you think? It's a great deal and all this kind of stuff. And he says, no, I'm not doing it. I'm not selling. In fact, I'm going to prevent you from selling the company with only 2%. Because it had to be a unanimous, every owner, every stock owner had to agree to the sale. So when it turned out, how we solved the problem was we bought his 2% back from him for a premium. So he would have made maybe 50 cents a share on his 2%. He made $1.50 per share on his 2%. But it was really expensive. It was a pain in the neck. It was a surprise, and it didn't have to happen. Had at the time he was given those shares, it was clearly stated in the documents. You leave the company, and those shares revert back to treasury stock and go back to the company. So, a lesson learned for what it's worth. How it will affect your ability to sell the company in the future. And here's some really good advice. Get legal advice when you put together your stock ownership program. That's a really good thing. So next thing we're going to talk about is pricing strategy. So last week we talked about this idea of exceeding customer expectations and philosophy. So this is where maybe you're a landscaping company and you've got lots of competition, and it's hard to distinguish yourself from your competition. One of the ways to do that is to ensure that your customer has this wonderful experience of doing business with you. And so it oftentimes works in your favor if you have this exceed customer expectations philosophy and you're working with pricing, because customers will see the value add benefit of doing business with you versus somebody else. When I like doing business with some company or a shop or a retail store, and they make that experience special for me, I'm willing to pay a little extra to have that experience. I'm willing to pay extra to have somebody say my name when I walk in the shop, right? Like they know me. So that's what we're talking about here with exceed customer expectation philosophy. It's a greater value to the customer than just price. So one of the things that we want to talk about, and let me just back up for a second, because there's one more point I want to make here. There is a concept in sales and in pricing that I think is really interesting. And it applies to buying a drill at Home Depot. So you've got a project at home and you need a drill. So you go to Home Depot and look for a drill. And you pay money for that thing on the shelf that comes in a box that says drill. But what you're really buying is the hole that drill makes. And so when you're looking at pricing, consider not just what the value is to your client up front, but what that long-term value is to them. Right? It's not the drill, it's the hole. Okay, so the next thing we're going to talk about is break-even point, and this happens when a company is trying to determine what they have to do or how much business they have to have, how much sales they have to have in order to break even. I'm not encouraging people to shoot for break even. That's not the point. But a lot of times it's helpful to understand where my break even point is. I have to do a certain amount of business to cover my expenses and break even. That's effectively what this is talking about. It's an algebraic equation that utilizes the combination of fixed and variable costs in your business. You can calculate it in percentages, or you can calculate it in sales dollars. And you can look at it from the point of view of day, by week, by month, by year. I worked at a company, that company I was telling you about in North Carolina, where for a period of time, we worked to a break-even point every month. So the controller and I and the leadership of the company would get together towards the end of every month, and we talk about where we were, what we had done, and we set goals for break even the next month. And break even, again, is not the goal, but when you're in hardship and you're struggling, that sometimes is the best way to set your sights so that people can get aligned and get behind what you're trying to do. So here are two break-even scenarios, and what we're looking at is the impact of fixed cost versus variable cost. And the sales are the same for both cases. So you see a budgeted sales of $20,000. Remember, we talked about variable costs varying based upon the sale volume, and fixed costs being pretty steady. So the benefit to our businesses is to have more variable costs than fixed costs. If situations change and our sales drop, then our variable costs will drop. But typically our fixed costs don't change. So here we're talking about, in case one, a fixed cost of $6,000 versus case two, where a fixed cost is $10,000, which means that variable costs are $10,000 for case one and $6,000 for case two. So they're just flipped. Variable cost percentages are 50% in case one, and variable cost percentages are 30% in case two. So again, we're looking at fixed versus variable costs and what it takes to break even based upon what that fixed and variable cost percentage is. And you can see that in case one, our variable cost percentage is 50%, and in case two, the variable cost percentage is 30%. Both come out with net income of $4,000, but look what happens. To make break-even sales, in case one, we have to sell $12,000 to break even, because we've got a higher percentage of variable costs. In case two, we have to sell $2,286 more because our variable costs are less and our fixed costs are more. So that the lesson here is, to the degree that you can manage your fixed costs to be as small as possible and your variable costs to be the majority of your cost base, that's what you want to do. You want your variable costs to be the bigger percentage.
We're not discussing anything to do with like cost. This is simply like costs
This is typically cost, like operating expenses.
Rent.
Exactly. Yeah. If we go back to the income statement, it would be included in, typically it's included in your operating expenses. Operating expenses. So there's some caveats to the break-even idea. And one of them is that your break-even point will change as the business changes, right? You make significant changes in the business, your sales grow, your break-even point may change. How are you going to see that? You're going to see that on your income statement. Your income statement is going to show you, okay, my cost of goods is growing. That cost of goods is typically a variable cost. Usually it's inventory, usually it's labor. Those things can be variable. So that's one of the ways that you would look at your income statement. It would help you understand where your break-even point is. Some costs are part variable and some are part fixed. If we think about that in terms of maybe sales expenses, right? When you're paying a sales person, you may have a variable cost for commission, and you may have a fixed cost, which is salary. So you can have variable and fixed in the same person or in the same expense category. Variable costs can become fixed if they're not managed. Overtime is a good example of that. Your variable costs, you can adjust what you pay in overtime, right? You can decide not to pay overtime. But if overtime becomes the rule and everybody does it, it becomes a fixed expense. Fixed costs usually have step increases. So an example of this might be, I've got a landscaping business. I've got one crew that is doing all my work, and I decide that I want to set up a second crew. I'm going to invest in a second crew. So that crew needs equipment, tools, lots of stuff to do their work for landscaping. So that becomes, those tools become fixed expense, mowers and other equipment. So that's important to know. When I add a new crew, I'm going to have a fixed expense, and it's going to go, 1 month it's going to be one crew, the next month it's going to be two crews. So my fixed expense is going to step increase. It's going to go up pretty dramatically when I do that. That's what it means by fixed costs usually have step increases. And then, the general rule of thumb is everything becomes variable when things go to hell in a handbag, right? If things are tough, all fixed costs become variable. There is a break-even template here in the handout, and it is a really helpful and clever tool to use if you'd like to use it. And what it does is it allows you to determine, for example, 1 month versus 3 months. You can fill this field in right here, and it will identify the number of months you're looking at. The yellow fields are where you would put in your information. The blank or plain fields are where calculations are. And what it does is it allows you to put in your costs, and it will calculate out what your fixed and variable costs are. And it will show you what your sales need to be for a particular period of time. And if you need help going through this, let me know, and we can spend some time together just kind of going through the report. I think it's useful to you. It would be well worthwhile if you want to look at it. We're going to kind of deviate for a moment and look at maybe something that you should consider in your business. given all of the things that we've talked about, the metrics, the reports, those kinds of things, it might make sense for you to consider bringing on a bookkeeper or somebody who can keep your books for you. And I think that's a really good idea, particularly if you're involved in the day-to-day operations of your business. If you're involved in production, or if you're involved in administration, or growth of your company, it's really difficult to have the responsibility of also managing all the financial transactions that go in and out. And a lot of times people will look at this and say, hey, well, there's just 3 basic transactions that I need to do, right? I need to bill customers, I need to record bank deposits, and I need to pay bills. And that's a lot of times what people think. But the fact of the matter is that's not going to keep books accurately. So there are a lot of transactions that go beyond those 3 that impact your business. And we'll talk a little bit about some of them here in a little bit. But what that means is that if you don't do the transactions properly, you're going to miss stuff. And your books, consequently, aren't going to be as accurate as they need to be. You're not necessarily going to see stuff that you need to see. An example of this is paying loans back, for example. Loan payments fall into 2 categories. There's the principal that you pay, and then there's the interest that you pay. The interest that you pay shows up on your income statement because it matches to a period where you're selling product. We pay interest for a month, so that interest payment should show up in the sales that you make for the month. However, the principal doesn't get applied to your income statement, it gets applied to your balance sheet. It becomes a liability. And that reduces every time you make a monthly payment, the liability on your balance sheet reduces by the amount of that month's payment. So having that understanding and knowing how to journal entry or categorize those transactions is important. It makes a big deal when you're looking at your P&L and looking at your balance sheet. Accounting systems are helpful in doing that, but a lot of times they're not enough. They're not somebody who's a professional, who knows what to look for, who knows how the transaction should be done, and sometimes it's not practical to pay an accountant to do it because they typically run at a different hourly rate. So having a bookkeeper do it for you with an accountant that kind of follows up maybe once a quarter or once a year when you're doing your taxes, that might make sense for you.
Like, I have a quick question.
Yeah.
Is it typical that companies, like with a bookkeeper, is it typical that part-time, come in once every couple of weeks, or I guess it depends on the size of the company, but we have 12 total people. And I'm just wondering, is it more typical to kind of outsource that, or to have someone employed to do that?
Yeah. So my encouragement to you would be to subcontract. Find a 1099 bookkeeper contractor. I'll give you some suggestions on where to go find those good, reputable people. So I would start there as a contractor. You may find that you love who you've got, and they do a great job, and you want to hire them. You may find that you're doing just as much work as you were before you got them, and it's not worth it to you, so you need to go find another. You've got the benefit because if you're doing it now, you kind of know how many hours it takes you per week to keep the books going. So you can go talk to a bookkeeper and say, it takes me 10 hours a week of transactions. I'm willing to pay you 10 hours a week to do this.
I think my biggest fear is like how to transfer the knowledge of because basically you're training them on like what these transactions mean and where they're categorized, right? So it's
Yeah.
like to teach someone else is like, almost seems like a bigger burden than what it is, like, useful for, like, to get it off my plate. So I think that's why I put it off, but, I'm sure there's great strategies.
So something that I can speak to personally, one of my daughters, actually two of my daughters, are bookkeepers. And one of them, Amanda, is remarkable. She's got a 6-figure bookkeeping business going on. And she brings on probably 3 new clients a month. Some are small, some are larger. But because she understands how a general ledger works, because she understands how manufacturing works, and because she understands concepts like inventory, sales tax, that kind of stuff, you're going to have to tell her how you've organized it. But you're not going to have to tell her how to do it. She's going to ask you, okay, is this expense a cost of sales, or is this an operating expense? And if you've got your general ledger and QuickBooks set up correctly, you'll be able to say, well, it's a GL account. You'll find it. So I think you'll find that the task, if you pick the right bookkeeper, the task is really not as hard as you think. And it will start paying dividends to you right away. Because one of the things I want you to do with them is say, at the end of the first month, I want you to produce me an income statement, a balance sheet, a cash flow statement, and sit with me and my partners and go through it together. And everybody will learn quickly. One of the things that's worth knowing, and I have a sense you already know this, is that keeping track of a growing business is difficult, right? The transactions change, you get new things. As we talked about, the business becomes more complex. And so what winds up happening is this kind of translates to more work for the bookkeeper. So one of the things that I would encourage you to do is engage a bookkeeper, bring them on by contract, but be open to the idea that they may need more hours as the business gets bigger and bigger. It's not a situation necessarily where their hours will stay static while the business grows. It shouldn't be commensurate to the growth of the business, but it will become more complex. That's why a lot of times larger companies will hire a bookkeeper at a certain threshold, a certain level of business. Maybe it's $4 million or whatever revenue. Maybe at that point you want to hire a bookkeeper.
So the bookkeeper would essentially handle all the loan payments, long-term liability, short-term, just basically everything, all transactions.
Yeah.
Produce reports based on the measures.
Any time a dollar moves or changes hands, or comes into the company or goes out of the company, they should have a transaction that shows you where and why it did it. Yeah. And we're talking the complete balance sheet, assets, short-term, long-term assets. We're talking about liabilities. We're talking about owner equity, the whole thing. They should be doing all of that for you.
And last question, would they be responsible for cutting the checks or just?
It can be.
Okay.
Yeah. So they can, if you want a bookkeeper to do your payroll, they can do payroll oftentimes. They can pay vendors. They can certainly do your your receipts from customers and deposits and that kind of stuff. They should be able to do all of that stuff. Now, as you get larger, there are some financial expectations for best practices. So you're going to want to start separating things like accounts payable and receivables from your other bookkeeping duties. And those are just best practices that your accountant can tell you about. But typically what you try to do is separate people that receive money from people that are spending money. Because sometimes you get funny things happening. Yeah, but in your situation, I think you're fine just bringing on a bookkeeper and having them do it all. And, my encouragement to you would be to have your accountant do it, do a review of your books, either quarterly, semi-annually, or annually when you file taxes. And effectively, what's going to happen is your bookkeeper is going to submit all of these reports, this general ledger, to your accountant.
We're basically giving them the CPA a copy of the books, essentially, and then adjustments.
Yeah. And I really liked your idea of maybe going to your CPA and seeing if they have bookkeeping services and using that bookkeeping service. I think that's a smart idea. Okay. Some other things, assume that bookkeepers are going to do a good job for you. Make sure that when you're talking to them, you ask due diligence questions. Ask about the accounting software certification that they have. QuickBooks is probably the largest accounting software package for small business. So it's not unusual for bookkeepers to have QuickBooks experience. Ask about it. Ask them if they have that. Ask if they have education. Do they have certificates or degrees around accounting? That's an important thing to ask for. Ask for references. Where else have they done bookkeeping services? Do yourself a favor and call their references. They will appreciate the fact that you're checking them before you hire them or before you contract them. Here are a couple of organizations that help you find different bookkeepers. So bookkeepinghelp.com is one. The COCPA is the Colorado Organization of CPAs. That is another that can give you referrals for bookkeepers, as well as QuickBooks themselves. Now, a word of caution, QuickBooks recently started providing services themselves instead of using third-party bookkeepers. They're kind of cutting the bookkeepers out and going direct to the consumer. So they're providing their own services for bookkeeping. And I don't have a good feel for how good those bookkeepers are. So I would encourage you not to go that route, but find somebody who has QuickBooks experience, a third-party independent person that has QuickBooks experience. I think that would be the best combination for you. You also want to ensure that you've got a CPA that can do your taxes for you, or you can take the route of tax return preparers. That might be some of the companies that we see around. I think what the references are for those. Oh yeah, like H&R Block. Those are tax preparers. And the difference is that H&R Block typically will have their own software that will allow people that work for H&R Block to enter your data and give you a tax return back. And that's helpful But it's not the same as going to a CPA, somebody who will take your books from you and do a return for you. You get a much higher level of service using a tax CPA than you will going to an H&R Block. In fact, H&R Block and some of the other companies that, like them will ask you to sign a waiver, essentially removing liability from them on your tax return. And basically saying, you know, this tax return is based completely on information that you've given me, as opposed to what a CPA will likely do, which they'll probably do the same thing, but they will ask you questions. They'll be much more familiar with your business and your books than just a tax preparer. Yeah, this goes back to just the point we were making about hiring someone to review your financials before having your taxes. So a couple of things to also consider. You know, we haven't really talked much about doing things like bank reconciliations and those kinds of things. Because there's so much money moving in and out of a company, and that money goes through a bank, doing those bank reconciliations is really important. And they're easy to overlook. They're easy to kind of pass by and say, you know, I just don't have time for it. I trust my bank or I trust my books and not worry about it. And oftentimes that hides mistakes, that hides problems. Something your bookkeeper should do for you are these bank reconciliations. You know, transactions come in and go out of the organization. You know, you can get, now we all are used to doing bank transactions on our phones. So there are a lot of things that are sort of outside the normal work of the business that influence your bank and your bank statements. You've got third-party payrolling processes that that influence, you know, what your bank pays, as well as what gets received. One of the things that we'll talk about here in a minute is when you receive receipts from sales, being able to separate the sales portion of that receipt from the sales tax portion of that receipt. If you don't have them separated, it's going to make your sales look larger, and you're going to get in trouble with the local state or the local city government because they want their money. If you're collecting taxes, they want their money. Customer credit and debit card processing become issues. Recurring electronic bills become issues. Debt payments become issues. So all of that kind of builds up into a need for making sure that you're looking at your bank statement reconciliations on a regular basis. Now there is a checklist in the handouts that I sent folks today. That checklist starts with a bank reconciliation. So my encouragement to you is when you're doing this reconciliation every month, have your bookkeeper check your book balances to your bank balances every month. Look at accounts payable aging monthly report. Confirm that all invoices are being entered into your system. This gives you sort of instant idea of how much you owe from month to month, where you owe money to your vendors and to your partners. This also helps you kind of keep track of which ones you're going to pay if times are tough and cash is tough, and which ones you're not. The thing is you want to match your costs incurred in a time period to the sales earned in the same time period. So if I'm using inventory to make a sale, I want the inventory that I've used to show up as cost of sales, and I want the sales to show up as sales or revenue for the same month. Sure.
So we're actually getting ready to make a bulk purchase like today for a pallet of material because there's a discount. So we're gonna get a bunch of this material, these formatted sheets, and it's probably going to take us 9 months to work it off. How would you input that? Would you spread it out over 9 months? Would you just put it all in under 1 month? Because the sales are gonna happen throughout the course of the next 9 months, when we get an invoice from the vendor.
Yeah. So are you working with the concept of raw materials versus work in process versus finished goods?
No.
Okay. All right. So you're probably gonna have to take it all in 1 month, which is gonna show a big cost in 1 month with not a big sales number associated with it, which is probably an issue. Because going forward, you're not gonna have that cost, but you'll have sales that it doesn't look like you've got inventory to support it, but you do.
Would you flag it some way? Like, would there be some way that you would personally flag it, or would you just to make sure that you know if you read a report, there is a big spike in expense that's not going to happen?
Yeah, I would probably somehow note it so that you've got it recorded. When in your manufacturing process, when you have the concept of raw materials versus work in process versus finished goods, then you can bring your material into raw materials. You show a receipt for it, but you don't show it as going to a project until you pulled it from raw materials, made a work order out of it, and then applied the material to that work order. When you do it that way, it allows you to see the cost of materials a little more accurately. Does that make sense? Yeah. Another thing to look at, look at loan statements monthly. Make sure that your balance sheet loan amount equals the loan statement from your lender. Do that monthly. A lot of times what happens is you'll get the interest portion of your loan payment combined in with your principal, and you'll think you're paying off your loan faster than you actually are. So that's an important thing to look at. The principal portion should reduce the loan balance. The interest portion should be an interest expense on your profit and loss statement or your income statement. Petty cash. Here's another place where it shows up. Do you guys keep a petty cash account? Good. Okay. Do you keep a petty cash account? You do? Okay. So petty cash is kind of an interesting thing. This is where you keep cash available to go buy something quickly. Maybe it's in an office and you want to buy paper. You run out of paper. So I need cash quickly. So I run to Staples. I've got cash in my petty cash account. I pay for the paper. They give me a receipt, right, that says I paid $20 for paper. And I take that receipt and I put it into my petty cash drawer or envelope. I start petty cash with a fixed amount, $200. That's typical. My petty cash balance should always be $200. I should either have cash in the account, or I should have cash and receipts in the account for receipts for stuff I've purchased. And those are the only two things that you should have in there, and they should always equal $200. If you see petty cash grow on your balance sheet, then something's not working right. So there's a way to look for a problem. Prepaid expenses are another thing. When like you guys are doing, when you prepay for inventory and then you use it over a period of time, a lot of times those expenses don't get reported properly. So that's an issue. Large or undeposited funds are also typically an issue. Maybe I'm I'm working on a project. My client gives me cash as a deposit. So I have this undeposited fund balance. That's sometimes an issue, making sure that you keep your funds straight. You don't show it as revenue because you haven't earned it yet. But that's something to look for. Other things to look for: equipment and fixtures and furniture showing up as an expense. If they have a lifetime greater than 1 year, then they should show up on the balance sheet, not on the income statement.
Is there a dollar amount, like an office chair?
Well, an office chair, think about it, it's going to have a lifetime value longer than a year. Probably want to make it a balance sheet item.
Okay.
Yeah. Now you can call an audible and say, I'm going to make this an expense. That's good. I don't want to fuss with depreciating the value of a chair. That's fine.
Just take it, put it in the furniture expenses.
Yeah. But the thing is that doing that over time, what's going to happen is it's going to inflate your cost of goods. And you're going to say, why is the cost of this chair being applied to this month where I built, where I made these sales? You're going to see the cost of the chair show up as your cost of goods sold, and you may not want that. You may want to say, well, wait a minute, this doesn't directly affect the production of the stuff that I sold. In that case, you'll want to put it as an asset into your balance sheet. Refundable customer deposits. Here's one: negative liability balances on the balance sheet. Should never happen. That's all I can tell you. And if you do, then what's happening is something is being applied to your balance sheet that's incorrect.
Could be, because I feel like I do have a few of them. I feel like maybe at the end of the year when the CPA does gives us journal entries back, maybe clear some of those out. Like
They probably will have to do that because you can't really carry a negative balance on your liability section of your balance sheet. In fact, what you might do, Jeremy, is you might go to your bookkeeper once you've had them on board for a couple of months and say, go fix these for me. Go find out where the negative balances came from and do a journal entry to change it. Here's another one. We're kind of running out of time here, so my apologies. I'm glad we had the conversation and the questions, but we may have missed a couple of these slides at the very end. So credit card payments is payments. Looking at balance owed on credit cards. Remember that a credit card payment, much like a loan, has two parts to it. It has the loan amount or the credit card fee amount that you're paying off, and it's got the interest effectively. So those show up differently. You've got finance charges, which show up on the profit and loss statement, and you've got the individual charges that may be showing up elsewhere based upon what the item is that has been purchased. These are particularly tough for bookkeepers to manage, credit card payments. If the owners in your business have credit cards, it's important that on a regular basis, on a monthly basis, they submit their expenses for what those credit cards are. Because if they don't, the bookkeeper can't balance those books. Credit card statements should be reconciled on a regular basis. If your bookkeeper is doing it, you should look for that reconciliation from them. A problem that we've talked about is, in the past is sales tax collected. If you've got a point of sale system or you've got an invoicing system and you're charging your customers sales tax. If you're a service provider, oftentimes you don't have to worry about it. But if you're a product provider, if you're charging sales tax, you have to have an ability to separate out the cost of the product from the sales tax portion. And if you're not doing that, then what's happening is you're overstating your sales, right? Let's say you've got a $10 sale and a $1 sales tax obligation. The customer pays you $11, but you show that as $11 in sales. That's not accurate. It's a $10 sale with $1 going into sales tax. Sales tax should show up as an account in your balance sheet so that you collect the sales tax that you've been paid, and at the end of every month, you pay that to the state or you pay that to the city, whoever you owe that to. So your invoicing should show what taxes you have to charge the customer for. Is it a state tax? Is it a city tax? Is it both? And they have to be pointed out there. Do you guys do that? Yeah, good. Okay. Yeah, sales tax paid a lot of times shows up as cost of goods sold or operating expenses. That's not correct. It needs to show up as an obligation on the balance sheet. Yep. Put sales tax collected in a sales tax payable account. That's a clearing account for each state or city separately. This shows up as a current liability on the balance sheet, and then every month when you pay your taxes to the state or to the city, you get to write that down. Getting to the end here, one of the things that also typically happens in a small business is you get owner distributions. So owner distributions are effectively draws or withdrawals or dividends that are paid to the owner or owners, as well as tax distributions. So a lot of times what happens, and you guys probably do this, is owners are able to pull from assets, from cash, enough money to pay their taxes. That's typically what happens. One of the problems is that amount has to clear and go to zero every year. So you don't carry it over from year to year. Every year you close it out, and if you've got a balance, an asset balance left over, that shows up as retained earnings. The intent is here to show how much owner distributions take place in the current year. So that's another report that you want to look at. At the beginning of the year, prior year distributions should be transferred to retained earnings. So retained earnings drop based upon the amount of the distributions that happened in the prior year, and you start over again. So this also is another report from the monthly review checklist that we worthwhile doing. And my encouragement to you is that monthly checklist is part of the stuff that I sent you this morning. And just look at that. That will give you a list of things to check each month or on a regular basis. I would encourage you to do it monthly, but you know, you may not have time. Then here are some other things also along with the material that I sent. You've got the break-even template. You've got the checklist that I mentioned. There's a worksheet in there for sales, trade-in, or disposal of assets that I think you'll find helpful if you do that. The pricing, despite the fact that I couldn't get it to work, it does work. And so I think you'll find that helpful. And then the glossary of financial terms is also in the stuff that I sent to you. So that's kind of a wrap. Anything else? Any other questions or things that would be helpful to you?
Where was this sent to?
So did you just register kind of at the end of the day, Karen?
I registered,
Yes.
the day before.
yesterday or the day before. Check your email and see if you got anything from me from SCORE. If you did not, then I will send it to you. And I have your, yeah, okay. Could you do me a favor and give me your business email address? Just put it on there.
Question, so
Yeah.
the reports that you were showing earlier, were those generated out of a specific program, like QuickBooks, or was it just something like you had the flower shop on there?
Yeah.
Assuming that that's something you probably over easily QuickBooks.
Yes.
Like the ones that I have just didn't look similar to the ones you have, but like those look very helpful, so I didn't know maybe that was.
Yeah, so what you could do is you could take that format, and give it to your bookkeeper and say, I want a P&L or an income statement that looks like this. And it may take them a couple of times to do it, but those income statements came from QuickBooks.
Yeah, that's what I was wondering, so I'm sure I've seen, customized.
Yeah. And then the worksheets or the templates, the break-even template, the gross pricing template are Excel spreadsheets that Tom Moore put together. And they are very helpful. Tom does a great job of explaining them. And if you decided you wanted some more time to work with somebody on it, I would do it, or maybe have Tom do it and just walk you through it. So they are really helpful. Other questions? Okay, well, very good. Thanks for sitting through this. Appreciate it. Yeah, you betcha. From online, are there any questions that you have? No questions? If you have questions, maybe in chat. Oh, great. Okay. Well, very good. Thanks so much for taking the time and sticking with it. Thanks, everybody. Cheers. Sure.
So, I get a little more in depth. Just a quick segment.